Welcome, entrepreneurs. It's fantastic to have you join us. We're embarking on a journey to unlock the secrets of smart business structuring. Today, we're diving into a topic that can make or break your financial future, a decision that will impact your bottom line for years to come. This isn't just about paperwork, it's about strategically positioning your business for optimal growth and tax efficiency. Your business entity structure. It's the bedrock upon which your entire financial strategy is built. Think of it as the blueprint for your financial house, the detailed plan that dictates how everything fits together, from income to expenses, assets to liabilities. Get it wrong and everything else is at risk. A faulty foundation can lead to cracks in your financial structure, potentially jeopardizing your hard-earned assets and future prosperity. The government gives you options, a variety of legal frameworks designed to accommodate different business needs and sizes. LLCs and S Corp are the most common for small business owners. They offer a blend of simplicity and tax advantages that make them particularly appealing. Here's the key. Understanding the fundamental difference between these two popular choices. An LLC is a legal structure, defining the legal existence of your business and providing liability protection. While an S Corp is a tax election. It's a way to tell the IRS how you want your business to be taxed. You can have an LLC taxed as an S Corp. This hybrid approach allows you to combine the legal benefits of an LLC with the potential tax savings of an S Corp election. This choice is your first and most powerful tax reduction tool. It's a strategic decision that can significantly impact your tax liability. We'll break down how each is taxed, examining the nuances of self-employment tax, payroll tax, and pass-through taxation, their advantages, exploring the benefits of liability protection, tax savings, and increased credibility, and what you need to stay compliant. Navigating the legal and regulatory landscape is crucial to avoid penalties and maintain good standing. The tax code changes, so staying current is essential. What worked last year might not be the best strategy this year. Your goal? Pay the least tax legally possible by choosing the right structure. It's about maximizing your after-tax income and reinvesting in your business. The government uses tax law as a series of incentives, a way to encourage certain behaviors and investments. Do what they want, and you get tax breaks. Align your business activities with these incentives, and you can reap significant financial rewards. Choosing the right structure signals you're a serious business owner, demonstrating your commitment to long-term success and financial responsibility. Not a hobbyist. It shows you're in it for the long haul and are willing to invest in the proper infrastructure. This mindset shift can dramatically reduce your biggest expense. By strategically structuring your business, you can unlock deductions and credits that significantly lower your tax burden. Taxes. Let's build your tax-free wealth foundation. A solid business structure is the cornerstone of long-term financial security and wealth accumulation. Ready? Let's get started. Let's dive into the specifics and empower you to make informed decisions about your business structure. The limited liability company, or LLC, is often the go-to choice for new businesses and entrepreneurs. It's a popular structure for a good reason, offering a blend of simplicity and liability protection that many find appealing when starting their ventures. At its core, the LLC offers a legal shield, a critical feature that separates your personal assets from the financial liabilities of your business. This separation is a cornerstone of risk management for small business owners. Without this legal separation, you're essentially risking everything you own. Your house, your car, your savings, all could be vulnerable in the event of a business lawsuit or debt. The LLC provides a crucial layer of defense. Now let's talk about taxes. For single-member LLCs, the IRS adopts a simplified approach, essentially ignoring the LLC structure for tax purposes and treating you as a sole proprietor. This means less complexity when filing. As a sole proprietor, your business income and expenses are reported directly on your personal tax return, typically using Schedule C. This simplifies the tax filing process, as the business's financial activity becomes an integrated part of your individual tax obligations. For multi-member LLCs, the tax treatment shifts to that of a partnership. In this structure, profits and losses are passed through directly to the owners, who then report their share on their individual tax returns. This pass-through taxation avoids the double taxation that corporations often face. Here's the catch, the part that often surprises new business owners. While pass-through taxation has its advantages, all net profit generated by the LLC is subject to both ordinary income tax, based on your individual tax bracket, and self-employment tax. This combined tax burden can be significant. Self-employment tax is a combination of what would normally be covered by both the employer and employee portions of Social Security and Medicare taxes, totaling 15.3% in 2025. Specifically, 12.4% of that self-employment tax goes towards Social Security, but it's only applied to earnings up to a certain limit, which is $177,300 in 2025. Earnings above that threshold are not subject to the Social Security portion of the tax. The remaining 2.9% is for Medicare, and unlike Social Security, there's no limit on the amount of earnings subject to this tax. Every dollar of profit is subject to the Medicare portion of the self-employment tax. This means that every dollar of profit your LLC generates is subject to these taxes, which can quickly eat into your earnings and reduce the amount of capital you have available for reinvestment or personal use. In summary, LLCs offer a relatively simple business structure with the significant benefit of personal liability protection. However, as your business becomes more successful and your profits grow, so too does your tax bill under the standard LLC tax structure. The self-employment tax can become a substantial burden. It's at this point, when the tax burden starts to feel overwhelming, that savvy business owners begin exploring alternative tax strategies to minimize their tax liability and maximize their after-tax income. This is where the S Corporation election comes into play, offering a potential avenue for significant tax savings. An S Corp isn't a legal entity. It's a tax status you elect with the IRS. The magic? You split profits into a reasonable salary and distributions. You must pay yourself a fair salary, just like any employee, and pay FICA taxes on that amount. The rest of your profit can be distributed to you, avoiding the 15.3% self-employment tax. This is a major tax advantage approved by Congress for small businesses, but it comes with more paperwork, payroll, quarterly filings, and strict rules on what counts as a reasonable salary. Don't try to game the system. The IRS watches for artificially low salaries. Do your research, document your salary, and enjoy the savings. The extra effort is worth it for the right business. For 2025, self-employment tax is 15.3%. 12.4% Social Security up to $177,300, and 2.9% Medicare with no cap. Both S Corp salaries and LLC profits are subject to ordinary income tax, but only S Corp distributions escape self-employment tax. The qualified business income deduction lets many pass-through owners deduct up to 20% of business income. Both LLCs and S Corp generally qualify, but S Corp W-2 wages can boost your QBI deduction if you're a high earner. 2025 is the last year for current tax rates and the QBI deduction. 2026 could bring higher taxes. Plan now to maximize savings under today's rules. The right structure could be even more valuable in a higher tax future. Make your decision with these changes in mind. Let's bring this concept to life with a real-world example featuring Alex, a dedicated marketing consultant running their own business. Alex is passionate about helping businesses grow and thrive through effective marketing strategies. Alex's LLC, after all expenses, earns a solid $120,000 in profit. This represents the hard work and dedication Alex puts into their business. Now, as a default LLC without any elections, all of that profit is unfortunately hit with the full 15.3% self-employment tax. This is a significant tax burden for small business owners. That amounts to a hefty $18,360 taken right off the top. And that's before even considering income tax. It's a substantial amount that impacts Alex's take-home pay. But what if Alex makes a strategic move and elects S Corp status? This simple election can drastically change the tax landscape. If Alex elects S Corp status and reasonably pays themselves a $60,000 salary, reflecting the work they do in the business, only that salary is subject to FICA taxes, which include Social Security and Medicare. This results in a significantly lower FICA tax bill, just $9,180 total. The remaining $55,410 is then distributed to Alex as the owner, and here's the best part, it's with zero self-employment tax. This is where the real savings kick in. The result? Let's take a look at the bottom line. Alex saves a remarkable $9,180 in taxes annually. That's over $765 a month that stays in Alex's pocket rather than going to the government. While the income tax liability is generally about the same either way, whether as an LLC or S Corp, the S Corp structure significantly slashes that burdensome self-employment tax. And this isn't just a one-time trick or a loophole. It's a source of annual savings, as long as the business continues to be profitable and structured correctly. That money can then be reinvested back into the business to fuel further growth, saved for future opportunities, or spent to improve Alex's quality of life. The right business structure puts real dollars back in your pocket, empowering you to make the most of your hard-earned income. This example clearly illustrates why your choice of business entity matters so much. Don't leave your money on the table by overlooking the potential tax benefits of an S Corp. Take control and make your business structure work for you, not against you. That's the power of smart tax planning and understanding the nuances of business entity selection. S Corps save taxes, but they're not free. LLCs are simple, minimal fees, no payroll, and easy tax filing. S Corps require payroll, quarterly filings, and a separate tax return, meaning more work and higher accounting costs. Expect to pay $40 $100/month for payroll services and higher tax prep fees. The S Corp only makes sense if your tax savings outweigh these extra costs. A good rule: if you can pay yourself a reasonable salary and still have $20,000, $30,000 left for distributions, consider the S Corp. Below that, the hassle may not be worth it. Let's break it down. LLCs, simple, cheap, easy to run, and offer liability protection. But every dollar of profit is hit with self-employment tax. S Corp, big tax savings on self-employment tax, more credibility, and easier income verification for loans, but more paperwork, higher costs, and strict rules. If you don't follow the rules, like paying a reasonable salary, the IRS can reclassify your income and hit you with back taxes and penalties. Choose the structure that fits your profit level, risk tolerance, and willingness to handle compliance. There's no one-size-fits-all answer. Make your choice based on your business's needs. Don't fall for myths. An LLC alone doesn't save you taxes, only the S Corp election does. Setting your S Corp salary too low is a red flag for the IRS. Always pay yourself a fair, defensible wage. Miss the S Corp election deadline? You might still qualify for late relief. Talk to a pro. Sloppy bookkeeping is a killer. Keep business and personal finances separate. Commingling funds can cost you your legal protection and tax benefits. Treat your S Corp as a real business. Separate accounts, clean records, and proper payroll. Don't assume you've missed your chance. Get professional advice if you're unsure. The right habits protect both your wallet and your business. Avoid these mistakes, and you'll keep your tax savings and your peace of mind. Stay sharp, stay compliant. Here's your action plan. If your net profit is under $40,000, stick with a default LLC for simplicity. Over $50,000, $60,000. Run the numbers. S Corp could save you thousands. Do a break-even analysis. Compare tax savings to extra payroll and accounting costs. Consider your goals. Need W-2 income for a loan, or planning to bring on partners? Talk to a qualified tax pro to tailor the strategy to your situation. Your business structure is the foundation of your financial future. Choose wisely and you'll build wealth the smart, legal way.